All right, well, let's talk about the new builder or the builders. Are they facing actually stiffer competition from the lack of massive recovery, or is it that existing homes are really giving builders the run for their money right now?
There's a lot of existing homes out there. In terms of volume, okay, new homes it's about 300,000 a year. Existing homes it's about 5.6 million a year. And with existing homes, there is a glut of foreclosure, okay, and B, there's the shadow inventory that the buyers are not releasing. So the homes are done, but they are not releasing onto the market.
Okay. Let's talk Manhattan. What do
Yeah.
you got for us for good news? We talked about all the bad
Right.
news. Let's
Okay.
whip out some good news.
The bottom is over for Manhattan, and the bottom was the third and fourth quarters of 2009. So the latest numbers that came out are the second quarter numbers, and it's positive by all signs. For example, the median price increased by about 3% versus last quarter, 7% versus last year. The transactions increased by, I think it's like 16% versus last quarter and 80% versus last year.
Wow. Okay.
Right? The days on market decreased by 16% and 35% versus last year. So all the metrics are positive. And it clearly shows that the bottom is over and the buyers are coming back. The foreigners are coming back.
Now, you did say the United States might actually experience a double dip recovery, even though some of those existing, or the number for existing sales is actually showing a positive sign. You say that might go into a double dip recovery just because, well, we got to get people back to work. What
Yeah.
about Manhattan? Manhattan's unemployment rate is pretty comparable to the rest of the United States, and we're also seeing an uptick in the prices. So how are you so confident that we're
Yeah.
not going to fall back into a double dip recovery too?
Manhattan is different because one, the impact of the first time credit is much, much lower. And two, the foreclosure rate is almost non-existent relative to the US average. And the reason is that majority of the apartments here are co-ops. So when one buys a co-op, one would have to go through the board review and so forth. And the board is not going to approve someone who is being stretched really tight in terms of finances. And Manhattan, Wall Street is recovering, so that's great. And I think the foreigners are really seeing that Manhattan is recovering. And 50% of our clients are foreigners. They come from Asia, they come from different parts of the world, and they are coming because they are realizing that it's a good bargain period right now.
Okay, so mortgage rates are low. They have a reasonable inventory to choose from. Why should investors look for that investment property in Manhattan versus either going to a REIT, a real estate investment trust, or the 10-year treasury? That's kind of safe.
Right. Well, the yield of the 10-year treasury is about 3 to 4%. And it's a very different play. When one buys a REIT, one is basically buying into the stock market because REITs track the stock market. It's very liquid. People go in and out whenever they want. But when one buys Manhattan real estate or real estate in any other city, one is actually investing directly in real estate. So the difference is that you get to leverage. You put down 20%, you benefit from 100% of the appreciation. And it's a lot less volatile. You don't buy and sell whenever you want. It's going to take at least 3 months for you to find a place. It's going to take at least 3 months for you to sell a place. So in terms of the return, and I did this analysis whereby when you compare the Dow Jones, okay, from 97 until 2009, the Dow went from about 7,500 points to about 10,000 points. Okay, that's an average annual return of about 2%. When you look at Manhattan apartments, it's about 10% per year. It went from about $350 per square foot to right now about $1,000 per square foot. It increased
At
by
a
about
minimum, I think I read
3.5%.
1,050 is the going rate per square foot in Manhattan right now, right?
Exactly.
Okay, so they are buying, leveraged-wise, a better investment than the stock market, yes?
Yes, definitely.
Okay, REITs actually have been outpacing the Dow, though. I heard that the Dow lost about 10% last year. REITs lost about 3.3%, or that was like the last quarter of it. So they
Right.
are slightly outpacing that. Is that because we are actually seeing an underlying recovery in real estate, or is that just because REITs are good investments?
Well, there are a lot of good deals. For example, there are a lot of REITs that are focused on distressed properties, commercial properties, whereby they are buying it cheap.
Okay.
By cheap, I'm referring to what they get in terms of the rental income relative to the prices they are paying.
Let's talk about rental income. You
Yeah.
have some good news there from Manhattan as well, correct?
Yeah. Yes. the rental market is picking up again, and for example, there are certain metrics. One is the vacancy rate, and City Habitats reported that the vacancy rate for Manhattan is a low 0.9%.
Wow.
And when it's below 1%, it's really low, and this is relative to the peak of about 2.5% back in February of last year. Now, the important thing is the context. Okay, so right now Manhattan's vacancy is 0.9%. The US average vacancy is about 9%. So
Woo.
Manhattan has very, very low vacancy, perhaps the lowest vacancy in the country. But anyway, that's good. The rental prices are increasing anywhere from 2 to 5% depending on the size of the apartment. The number of units available for rent is decreasing, so the rental market is picking up as well as the sales market.
Excellent. Good, good, good. So you're saying that, yes, Manhattan has bottomed out. We're not headed for a double-dip recession. The rest of the United States might be headed for a double-dip recession depending on how unemployment goes. But for the most part, a safe investment is right here in NYC, yes?
In Manhattan. And Manhattan is a bargain, actually, relative to its peers. And Manhattan's peers should be London, Paris, Hong Kong. And there was this report by Knight Frank and Citi Private Bank that shows that Manhattan is the #1 real estate market in the world based on desirability. And the metrics they use are economic activity, political strength, knowledge, and so forth. So Manhattan is the #1 ranked real estate market. But when you look at in terms of the price per square foot, Manhattan is a lowly 10th. Okay, Monaco is #1, like $4,500 a square foot. London,
goodness.
Paris, Tokyo, Hong Kong, Rome, Geneva. Manhattan is number 10 at 1,000 plus per square foot. But in terms of the desirability and the attractiveness of Manhattan as a real estate market, is #1.
Wonderful. All right. Well, Wei Min,
Yeah.
thank you so much once again for joining the Political Chick. We got a little bit of good news in the housing market and possibly a bottoming out across the United States. If you had to guess, what would you say? Is it a 50-50 that we're going to see a double dip reception for the rest of the United States, or are you a little more positive? You think that everybody is going to pull out of this? We might see a V, maybe a V just taper off, or you might see a V curve. What do you think?
The US average, and I don't think there's a city that can be the US average, so we are just averaging numbers here. The US average may see a 10% decline.
Okay.
In Manhattan, I think it's going to be a steady increase. It's not going to be a V, because right now prices are still 13% lower than the peak of spring of 2008. But real estate here in Manhattan, I think, is still a safe bet.
Okay, so it's more like a U in Manhattan, but the rest of the United States
Right.
needs
to come down by about 10% because of the high unemployment, because of elimination of the subsidy, and because of the glut of inventory that's out there.
What would you like to see change? Would you like to see the Obama administration extend that tax credit once again, or is this it? Just keep the mortgage rates low, they're doing what they need to do, and let the market just figure itself out.
The market should figure itself out. The government should get out of the business of helping stimulate the economy and providing subsidies.
Why so? Because it's not working?
Because it's not how a free market should work. And America should be the free market and capitalistic example for the world. And when you have subsidies, it's turning us towards more of a socialist kind of society as opposed to a capitalistic society.
All right, so let it go, let the
Yeah.
mortgage rates stay low, and let's figure this out and get it back on track, right?
Right.
Okay, great. Thank you so much, Wei Min Tan. You can find him at castle-avenue.com. He is a partner again in Castle Avenue Partners. They specialize in investment properties. So thank you so much.
Thank you, Lisa.
All right, and we'll
Right.
see you back here on the Political Chick some week soon.
Okay, thank
Thanks
you,
a lot.
Lisa. It's a pleasure.
All right, coming back on the other side of this break, we're going to talk to the author of Nullification. It's funny, Wei Min just mentioned a point of let the federal government just stay out and let the free markets rule their own selves. Well, guess what? That's what this book, Nullification, is all about, but it's about the states taking that power back from the federal government. We're going to talk all about it. Stay tuned. You're not going to want to miss it.